Good day, ladies and gentlemen. Welcome to a Thursday takeaway. We had some breaking news yesterday regarding the Fed's decision, and they decided to raise rates by 0.25%, which was to be expected. But the question is if they've gone too far, raising rates too fast. If you've been following the show, you understand that we have raised rates at an unprecedented level in history, and thus we do not understand the full effects of the interest rate hikes until 12, 24, or even like 38 months later. And so that is the question, is whether they've overdone it. But I also want to go into article that I read, kind of referring to what we're seeing right now, similar to the 1970s economy. And I have some arguments to justify maybe why that's wrong and why we're also seeing the saving rates decrease about Americans. And we'll also look at the manufacturing data that came in, suggesting a pretty 9 month slowdown. So let's dive into it. So Wall Street economist says recession in 23 would look like the biggest crisis of 1970. People are too focused on '08 and 20. This is more like 1973, 74, and 2021. Piper said, and Nancy Lazar in the morning. Lazar predicted feeling of a full impact of the recession in the second half of 2023 as the lagging effects from the Federal Reserve rate hikes take hold. So let's digest this a little bit. So she burned 1970, a very different time in our economy. First of all, in the 1970s, we were a very manufacturing based economy. We were producing our own goods, and Americans were buying their own goods. Now we have transferred over to more of a globalization where we have become more of a service oriented economy versus manufacturing. And so, what happened during the time of the 1970s is what we saw a period of high inflation, but that was mostly due to dollars remaining trapped in our economy and no way to export them. So what's the difference now? Well, like I said, we're a service-based economy. We can export our dollars overseas, and that's a major key takeaway and why it's kind of different. So and then she also, regarded the lagging effects of the interest rates. Yes, that's a major factor. But first, let's look at the consumer price index, which is in blue, and GDP in red. See, back in the 1970s, we saw these trends run tandem with each other. As inflation rose, we also saw that GDP rose with it. And then as GDP declined, we saw inflation decline with it. But really, right after the 1980s, we really see GDP kind of just stay still in tandem, and then all of a sudden it shoots up, and now we're seeing them run parallel to each other again. So we're now seeing, inflation starting to drop off and GDP starting to decline. Also, another interesting is the total effect of the inflation and the Fed's tightening cycle. So look at this. As the Fed was increasing its rates to combat inflation, we see that they tend to drop rates at the top of the peak inflation and it comes back down. And this is, when dollars couldn't leave our economy, thus keeping the money velocity high in inflation. But it's totally a changed atmosphere, which I'm trying to articulate. While the Fed is targeting at PCE headline figures, it tries to wrestle with consumer prices back to 2%. Previous told reporters that core data is actually a better indicator on inflation. Both the core and headline numbers point to inflation that is running well above the Fed's two preferred target, and troubling sign that the central banks are already hiking interest rates at the fastest pace in decades. So what they're saying is basically if you take a consumer's expenditures and how much they're paying on a monthly basis, the CPI in that really correlate. And here's the latest chart that shows that. And what we see is that actually, yes, the CPI may be running the consumer price index of all urban goods, gas expenditures is running high, but the main thing that's really propping up the CPI in the data is energy and gasoline prices. If you look at the blue line, which is the personal consumption and expenditures of a U.S. consumer, you could see that that level is is on its way below 2%. So is it justified to increase the rate hikes, or is it time to pause? That's the question. We think there will be a future starting out in the second quarter and then an outright decline in the back half of the year. Because you had first a global tightening cycle in 2021, the lagged effects that hit the US economy with our multinational economy. Second, oil prices surged in 21, and third, bond yields rose significantly. So what slowed last year are those three metrics. Going into this year, The lagged effects from the Fed tightening cycle is reflected on the money supply now declining, like we saw in the past chart. The only thing that's really popping up the CPI is energy. When it comes to the labor sector, Lazar pointed out dark clouds hovering over the unemployment numbers. Yes, we did have a resilient information come in as December regarding unemployment, which stuck at that 3.5% level. But if you're a follower of the show, you understand that before the pandemic or after the pandemic, when we reopened, there was an immense amount of companies, especially in the tech sector, hiring at an unprecedented rate they've ever seen in history because demand was there. We had a bunch of fiscal stimulus in the economy. It was justifying that. So, what do you do if you're an employer who just trained an employee for 2 years and now you're worried about an economy that's slowing down and you're looking to cut down on your expenses? Well, you're going to wait. You're going to wait to see how this first year goes. And regarding how the first quarter and second quarter go, you'll have a justifiable reason. And we look into it and we can now understand that yes, these layoffs are now starting to have effect in the economy as we see personal savings rates at an all-right low. I just read that LinkedIn article that showed 28% of people who had 401ks at Fidelity took withdrawals this year to justify the expenditures that were so high. And so, what is the effect of where are consumers spending money? They're not spending it on goods and services. No, they are spending it on paying off debt, credit cards. And we can see it right here as the personal saving rate is at its lowest that it's almost ever been in history. And that should be worrying. And so, thus, that 401k, people are taking tax hits on this. It is not looking pretty. And the first half of this quarter will really determine if that rate, saving rates goes even lower and we see unemployment kick up along with it. Um, it's going to be a very bumpy roller coaster. It's headed down, Lazar said, but there in January, we think we could get a little better. We really don't see a recession until the back half of 2023. We think that the first half is actually going to be muddling along. And the reason why they're not able to assess an accurate like prediction is the same reason why the Fed doesn't know when to stop on the interest rates. The Federal Reserve hires more PhD economists than anyone in the entire world and still cannot determine when to slow down the rates or what will happen after they raise all the rates in the cycle after that. No one can predict that. And so that's why this first half of the year is very important to determine where this economy is going. Because if we see the consumer stop spending like I predict we will, then we're going to see more layoffs and the unemployment rate kick up. Like I said, the Fed did raise rates yesterday, and now they're in the threshold of 4.5 to 4.75 on the federal funds rates. And here comes to the argument of whether that was justified or not. The argument is just whether you should pause after 3 months of data or pause after 6 months of data. Waller said on January 20th. Form the risk management side, I need 6 months of data, not just three. So he's arguing that the data, the lagging effects from the interest rates have not fully hit the economy, and to make to make the assessment to raise rates again without using more than 6 months of data is just not justifiable. The personal consumption expenditure index rose at 2.2 and the 3 months through December on an annualized basis of 3.7. Over the past 6 months, a slowdown from its 4.4 pace in the last 12 months in reports. So we're seeing that the expenses are coming down. We have the data. But why did the Fed decide to do that? Well, they got tricked, and it happened in May of 2021 when inflation was starting to cool, and then all of a sudden it shot back up. So that could be one of the fears and why they're facing it. Now, I want you to look in the red. This is a 3 month minus the tens, which is our Treasury yield curve inversion. Here's the fake out in May where we saw a decrease in inflation and shot right back up, and that's when we started to increase the 75 basis point rate hikes. But every time we go below this black line, it's always the next step is that we're in recession and rates are coming down. We go below, rates start to fall. And we go below, rates start to fall. We go below, rates start to fall. And all simultaneously, we see inflation fall with it. So that's just a kind of a trend I wanted to show you. Secondly, if you followed last week's show, we talked about the manufacturing data, which is an important part of the United States economy because it really helps determine how much inventory and how much supply is out there for, and what is the demand like for consumers buying goods. Um, the recession is on its way. That's from the Dallas Fed. Factory activity slumps for 9 straight months. We have been negative on the factory sentiment. So the green is the manufacturing outlook of general business activities. As you can see, I've shown you this in the past, but like during the pandemic, that completely slumped. Right now, we're in line with multiple recessions. And I want you to look at 2015, 2016, because that's when we started these interest rate hikes. And we saw that we almost tipped into a recession. And right now, we're seeing very similar signs. Will it get worse? Who knows? Will there be a soft landing scenario? It really just depends on how the consumer is behaving. And right now, based on the consumer tapping into its current savings, I'm arguing that probably no, that we'll probably see more of a deeper recession in the back half of this year. And mostly just due to, I believe, cost cutting measures taken on by companies and the data and the manufacturing sector being one of the core leading indicators to justify that position. So, just wanted to throw that out there. I think there's some valuable information. Uh, see the consumer saving rate depleting. It's important to know these facts and understand where we're going. So, as consumers, we can be really mindful and frugal about how we're making decisions, but also these can be very good opportunities. Thank you so much for watching these shows. Hopefully, you learned something. As always, thank you and have a wonderful day.